All right, so let's see. In the last class, I believe the final thing that we did was we did one of these exercises where we used the present value concept to figure out the yield to maturity on a couple of different bonds. One was a discount bond and another was a coupon bond with 5 years to maturity. We discussed the formula that was needed in order to determine what the yield to maturity is. You guys remember what this is? So this is an important concept in financial economics. The yield to maturity is the interest rate that balances the price of an asset, like a bond, with the present value of all the future payments from holding that asset. If you have a financial calculator in order to compute yields to maturity, you're more than welcome to use that. If not, however, there is an Excel spreadsheet that I have, and I think it's posted to Blackboard, that you can use to solve for these things. Now, I would never ask you this in the context of an exam, because not everybody necessarily has a financial calculator. But as long as you can write down the equation that is consistent with the yield to maturity, that is the right present value equation, I'll give you, you'll get full credit on that. But nonetheless, let me just really quickly show you guys how to use this spreadsheet that I have available in case anyone wants to use it. So I don't know if you remember this, but the last question that we did in class on Monday was that I asked you to find the yield to maturity on a 5-year corporate bond that had a face value of $1,000 and a coupon payment of $100 annually, so a 10% coupon rate. And the price of that 5-year corporate bond upfront is $975. And so the question then is, what is the yield to maturity? And we wrote out the equation that is consistent with what that interest rate is, what that yield to maturity is. And then I believe one of you guys in here figured it out using your calculator that it was around 10.67%, something like that. This spreadsheet will compute that yield to maturity for you. So let me just really quickly show you how to use it. Here is the basic characteristics of the bond: the coupon payment, the face value, and the security price, and the number of periods until maturity. That's what you would enter in depending on what the characteristics of the bond are, okay? Over here in columns C through F, we're going to have different information on the price of the bond, as well as the present value of all of its future payments, depending on different candidate levels for the interest rate or the yield to maturity. So for example, let's suppose I consider interest rates between 1% and something higher in increments of, let's say, 50 basis points. So I'm going to consider interest rates here between 1 and 20%, or 20 percentage points, in increments of 50 basis points. What column E shows you is it basically just uses that present value formula that we talked about in the last class to compute the price of this security given a yield to maturity of 1%. Now, if the true yield to maturity was equal to 1%, then what would we find? We would find that the price of the bond, which we know is $975, would be exactly equal to the present value of its future payments from owning it. A candidate yield to maturity of 1% is obviously not close. The difference between columns E and column D here is like close to $500. So that means the true yield to maturity must be much higher, okay? Now, if we go down here, you can see that the difference between column E and column D rises towards 0, and somewhere between 10.5% and 11%, the error goes from a negative number to a positive number. So the true yield to maturity then must be somewhere between 10.5% and 11%. All right. So all you have to do to find it is just make your grid of different possible interest rates more fine. more granular. So let's start from 10.5% and consider them in increments of just 1 basis point at a time, and see if we can figure out closer what the interest rate is going to be. It should be the point at which the difference between the bond price and the present value of the future payments is basically zero, which occurs down here at about 10.67%, right? This is a clumsy way to do it, but not everybody has a financial calculator. You can go online. I'm sure there's a program you can type online to do it. But if you want to use this spreadsheet, you're more than welcome. You may have to compute 1 or 2 of these on your lab assignment before the final exam. So I just wanted to show it to you really quickly there. Okay, any questions then on that? All right, let's move back to the slides then and pick up where we left off in the last class. Okay. So we talked about coupon bonds in particular. These are important financial market instruments in order to understand how market interest rates are determined in the economy. Many of these coupon bonds that are issued by the government or by large corporations typically have long maturities, sometimes as much as 30 years, all right? Now, most investors who buy one of these long maturity bonds are not actually going to hold that bond all the way until the maturity date, okay? Bonds are a lot like stocks in the sense that investors buy them and they sell them in secondary markets at dates in the future, hopefully at prices that are higher than what they originally paid for them, okay? Once a government or a corporation issues one of these bonds in a primary market, they're no longer involved in any of these subsequent transactions, except to the extent that the government or the corporation needs to know who the bearer of the bond is so they can pay the right person the coupon payments, okay? Here's the question I want to start with class today. What do you suppose happens to the price of one of these bonds in a secondary market if after it is first purchased, interest rates or yields to maturity on newly issued bonds starts to change? So let's say you were to purchase a bond at some particular interest rate, but then later on, as you are holding that bond, interest rates on newly issued bonds are actually different than the ones that you purchased in the first place. What do you imagine happens then to the price that your bond is going to fetch in a secondary market? Now, this is kind of a theoretical question, but I want to try to answer it using a concrete example so that this makes as explicit sense as possible, okay? Let's suppose that you purchase a 30-year coupon bond. Lauren, let's say from the Ford Motor Company, and you purchase this bond for $1,000. The par value of the bond is also $1,000. And the coupon rate is 8%, which means every year that you hold it, you're going to get an $80 coupon payment. And by the way, anytime you buy a bond for the same price that its face value is, then the yield to maturity is going to be the same as the coupon rate. So the yield to maturity here is also 8%. Okay, Lauren, let's suppose now that you have held this Ford 30-year coupon bond for 1 year, and you've collected the first coupon payment of $80. But now Ford starts to issue newly issued 30-year bonds that have a coupon rate of 10% instead of 8%, okay? You might like to sell your bond so you can buy the one that has a higher coupon rate to take advantage of the higher coupon rate here. If you decide to sell your bond to, let's say, me in a secondary market, then what price am I going to be willing to pay for it? How much will your bond fetch in a secondary market? What was the main thing that we tried to learn in the last class? Was that the price of any asset is equal to what? The present value of all of the future payments from owning that asset, right? So Santiago, do you ask a question or do you have an answer? Okay, what's your answer? Sorry? That's true. And we can figure out exactly how much they're going to go down in this case. That is the price, right? What would be the price that Lauren's bond is now going to fetch? Well, it's the present value of all the future payments from owning it, right? Now, the coupon payments are the same. That doesn't change. It's still, the bearer of Lauren's bond is still going to receive $80 a year. The difference here now is that Lauren has already taken the first coupon payment. So there's only going to be 29 of them left, plus the face value of the bond discounted back 29 years, right? So there's one fewer term in this present value expression than there was earlier. What else do you notice is different now about the present value of this bond? It's not just the number of years that you're adding up, but what is the interest rate at which you have to discount this particular bond that is dated 1 year now? It's no longer being discounted at an 8% interest rate. It's being discounted at a 10% interest rate. Remember how we determine how much to discount future payments. It's based on the rate at which you could earn on your next best available investment opportunity. Well, now that the new 30-year bonds have a coupon rate of 10% or a yield to maturity of 10%, then you're going to have to discount all of these future coupon payments by a higher interest rate. Okay? Now, if we add that stuff up, or alternatively, if you use our little handy dandy formula here that we talked about in the last class, the coupon payment $80 times this expression here, 1 minus 1 over 1 plus the interest rate, raised to the 29th power over the interest rate, plus the present value of the face value of the bond, you're going to find that it's $812.61. The present value concept then tells us exactly how much, or the maximum that an investor would be willing to purchase Lauren's bond now in a secondary market. In this case, if Lauren sells her bond, she's going to experience what's called a capital loss, right? This occurs when the market price of an asset declines. She bought the bond a year ago at a price of $1,000, but now, because interest rates on similar bonds have risen to 10%, if she tries to sell her bond to somebody else, it's only going to be worth $812.61, worth much less than what she had originally paid for it. Let's do the reverse question here. What if instead Ford, yeah, Chandler? Yeah. Well, you can figure that out, right? So instead of putting 0.1 here, put 0.08 here and add all that stuff up and see what you get. Well, the other bit of information that affects the total present value is the absence of the very first coupon payment. She's already collected that. So there's only going to be 29 left. So that reduces the value of the bond some. But really what's reducing the value of the bond more is the fact that you're discounting all of these future payments at a higher rate now because there's an alternative asset that could be bought that has a higher coupon rate of 10% instead of 8%. Well, you would have to plug in the numbers to see whether it would be a loss or a gain. I'm not sure off the top of my head. You mean if coupon rates had stayed the same? I think it would be worth a little bit less than 1,000, but I'm not 100% sure. I'd have to plug it into the formula to see because of the absence of the first coupon payment. Yeah, I'm not 100% sure. What happens here if instead the coupon rate were to fall to, let's say, 6%? So now the coupon payments on newly issued bonds are $60 a year instead of $80 a year. We can do the same exercise to figure out how much Lauren's existing bond is going to be worth in secondary markets, right? It's now the present discounted value of all 29 of the remaining $80 coupon payments, plus the present value of the final face value of $1,000. But now the discount, the rate at which you discount these future payments is lower because the next best available investment opportunity has a lower interest rate of 6% instead of 8%. Now, when you add all of those things up, you end up getting $1,271.81. In this case, Lauren will have experienced a capital gain, right? The price of her asset is now higher than what she actually purchased it for. And in this case, Chandler, the capital gain is exclusively attributed to the fact that the interest rate is lower, right? You're discounting those future payments at a rate that is lower than what you had previously done. Okay. That's correct. Yeah. In spite of the fact that you don't get that whoever purchases the bond from her is not going to have received the first coupon payment. Okay, so hopefully this exercise illustrates the point or the conclusion actually that Santiago reached a few minutes ago. And that is the idea here that yields to maturity and bond prices are going to move in opposite directions. As bond prices go up, interest rates or yields to maturity have to go down. As bond prices go down, yields to maturity are going to rise. Okay, so interest rates and bond prices always move in opposite directions. Okay, now that's pretty easy to think about when you look directly at the present value formula, right? The interest rate or the yield to maturity is in the denominator of all of those terms. So as the interest rate goes up, the present value calculations have to shrink, which means that the price of the bond is going to fall, right? Alternatively, if the interest rate gets smaller, those present value terms get bigger, and so the price of the bond is going to rise. You can see that mathematically by just inspecting the formula, all right? But what is the economic rationale here? Why does it make sense that if interest rates rise, existing bond prices are going to fall? Lauren? Yeah, so when interest rates rise, then Lauren's existing bond is less attractive relative to the new ones because the coupon rate is lower compared to what you could get on a new bond, right? In order for Lauren to entice an investor to purchase her bond, which is going to be less attractive than the new ones, she's got to offer her bond at a discount, at a reduced price. That's the only way she's going to get some other investor in a secondary market to buy her existing bond is if she drops the price below $1,000. Alternatively, if interest rates fall, now, Lauren, your bonds look more attractive than what is currently available or that is currently being newly issued, right? And you're actually, in that case, you would actually be able to extract a higher price from another investor for your existing bond because your coupon rates are relatively higher in this case. So bond prices and yields to maturity are inversely related to one another. Okay, you guys have any questions then about that particular result? Is everybody comfortable then with the present value concept? How to price the various type of bonds we've talked about in this class. So we've talked about three, right? Zero coupon or discount bonds. We've also discussed perpetuity and also coupon bonds. A perpetuity is like a couponed bond that essentially never matures, right? You never get the face value back. All three of them, despite the fact they have different timings of their payment streams, can be priced in the same way, that is using the present value concept. Okay, so now that we, I think, fully understand interest rates or yield to maturity, and how the yield to maturity is the rate that balances asset prices with the present value of its future payments, I want to spend the rest of class today talking about or discussing the economic forces that actually cause interest rates to move around over time. If you look at data on any different type of bond over time, you're going to see that interest rates are somewhat volatile. They bump up, they bump down. They never just stay flat forever, okay? Now, what we just learned here is that interest rates or yields to maturity are inversely related then to bond prices, okay? So it's easy enough then to explain why interest rates fluctuate over time, that is why they change the way they do, if we can simply understand why bond prices change, right? If bond prices and interest rates are inversely related to one another, then if we can explain why bond prices move, we should also be able to explain why interest rates move around as they do. Okay, now it is just a statement of fact. Hopefully you guys understand this at this point, that bond prices are going to change as a result of the constant interaction between the demand and supply for bonds. Okay, now typically when we think about demand and supply curves, we draw the demand and supply model using with price on the vertical axis and quantity on the horizontal axis, okay? Now, of course, bond prices are important, but what we are interested in here is what happens to interest rates over time. However, we can simply use this present value concept in order to determine what the interest rate is once we have determined what the bond price is going to be in equilibrium, right? So this is just the general formula for the price of a couponed bond, right? We know that the coupon payments and the face value of the bond are going to be fixed for a bond that has a given maturity of N periods, right? If we use a supply and demand framework to understand what causes the price of a bond to move around, then we can simply apply this present value formula to understand how interest rates move around over time as well, okay? This approach to explaining how interest rates are determined, which I think was the title of this section of the course, is what's referred to as the bond market approach to interest rates, all right? It's the idea that you can think about what determines interest rates by studying equilibrium in the bond market, where the good that is actually being traded is the quantity of bonds in circulation, right? There is an alternative economic model that you probably discussed in your principles class, maybe even your intermediate macro class, called the loanable funds model. You guys remember that? That's a very popular model in principles to talk about what determines interest rates. In that model, what is the good that is being traded? It's the actual real resources that are used for investment purposes, right? In that model, the supply of loanable funds comes from people who are saving resources, and the demand for those loanable funds comes from people and businesses that want to invest in capital expenditures, okay? The interest rate adjusts to balance the supply and demand for loanable funds. The model that we're going to talk about for the rest of class today is slightly different. It's the bond market approach, meaning that the good that's being traded is not loanable funds per se, but the bonds themselves, right? And so the suppliers of bonds are going to be folks who are issuing those bonds, right? That is people who want to borrow, not people who are saving. And the people who want to demand them are going to be the savers. So the market role is slightly flipped. But you can still use that as well as the present value concept to think about interest rates in equilibrium. So let me make an attempt to do that. So here is kind of a generic supply and demand model for a typical bond, okay? Let me talk about the demand component of this model of the bond market first. What does the demand curve represent? What does it tell us? It tells us the relationship between the price of a bond and the total quantity demanded. And of course, it's going to be downward sloping. Now, why does that make sense? Why would the demand curve for bonds slope down? As the price of a bond falls, investors who are thinking about purchasing it are going to be more willing to purchase bonds, right? When you buy a bond, that guarantees you a fixed stream of income in the future, right? So if the upfront price of a bond falls, then the total size of the reward that you're going to receive in the future relative to what you have to pay for the bond upfront is going up. And so bonds become more attractive for investors as bond prices fall. So the quantity demand is going to increase in this case. What about the supply of bonds? So here we have, as the price of bonds rises, the quantity of bonds supplied in the market is going to go up. Supply curve has its standard upward slope to it. Now, first off, let me clarify something. First off, who is it that is supplying bonds in this particular market? So there's a couple of sources that you need to be aware of, I think, to understand everything today. Well, I guess the most obvious potential supplier of bonds would be investors who are holding existing bonds and who may be willing to sell them in secondary markets, right? Depending on what the price is. The higher the price that they would fetch, the more likely someone who holds a bond would be willing to sell it. In our previous example, Lauren might not be willing to sell a bond if she can only get $800 and change for it. But if the bond price were $1,200, she might be much more likely to supply the bond, okay? But who else is supplying bonds? Not just investors who hold existing bonds, but also governments and businesses who are thinking about issuing new bonds in primary markets, okay? Why does it make sense that a business, let's say, might be more willing to supply new bonds as the price of bonds goes up? Santiago? Yeah, and a business that is supplying a bond is borrowing, right? So when a business issues a bond, it knows that it has fixed payments to the bond bearer in the future. If it can receive more money up front for that bond, then it's, if I'm saying this correctly, reflecting what you're saying, their cost of borrowing is going to go down, right? So governments and businesses are more likely to issue more bonds as the price of bonds goes up, okay? All right, so let's work through this little example here. The figure actually illustrates the market for a one-year discount bond that has a face value of $1,000, and again, a one-year maturity, okay? So in a perfectly competitive financial market here, the price of this bond should adjust to exactly balance supply and demand. That's what we would see in the market. And according to this graph, it occurs at a price of $960, all right? Once the market determines what the equilibrium bond price is, then we can easily determine what the actual yield to maturity is, right? We know what the yield to maturity is from the present value formula. On a one-year zero coupon bond, the yield to maturity is the face value minus the bond price divided by the bond price. So it's 1,000 minus 960 over 960 gives us 4.2%. Right? So this super easy little example illustrates the point that the supply and demand model for the bond market, of course, determines what the price of bonds is going to be in equilibrium. But once you know the price, we also have fully determined what the interest rate or the yield to maturity is, right, through the present value formula. If I can go over this pretty briefly here. If we want to think about the adjustment process in the bond market, if you imagine for a moment that the price of the bond was $980, then what type of situation are we observing here? This is one in which the supply of bonds would be 600 billion, but the demand for bonds would only be 400 billion. So we have a surplus of bonds in circulation, or a surplus of bonds in this particular market. We're going to have sellers unable to find bond buyers. In that situation, in a perfectly competitive environment, then sellers are going to start to bid down the price of bonds as we approach the equilibrium, okay? Any price below the intersection point here, you get exactly the opposite situation. Here at $950, we have a demand for bonds equaling 550 billion, but a supply of only 450 billion. So there is a excess demand or a shortage of bonds in this market in the amount of what, $100 billion worth? Okay, so here you have potential bond buyers unable to find sellers at the existing price of $950, right? And so they're going to start to be willing to pay more than $950 for the bonds, and the price will be bid up until equilibrium is restored, right? So at a bond price of 980, prices should fall and interest rates are going to rise. They're inversely related to one another. But here from below, bond prices are going to increase and interest rates will fall. Be careful about that, okay? When we talk about the adjustment to the equilibrium, remember that whatever direction the bond price moves, the interest rate is going to move in the opposite direction. Okay, you guys have any questions then about that so far? Straightforward enough? All right, so now that we've developed this pretty straightforward, basic kind of demand and supply model of a, let's say, a generic bond market, I think it's pretty clear how we explain how interest rates change over time. The only thing that's going to cause interest rates to change would be changes in bond prices. Equilibrium bond prices are going to change if something happens to the demand and or the supply curve for bonds. In the real world, there are constantly shocks that cause the demand for bonds or the supply of bonds to move around, and therefore cause the price of bonds to change in equilibrium. That will in turn cause the interest rate to change as well. What I want to do for the remainder of class today is talk about some of the key factors that might cause demand for bonds as well as the supply of bonds to shift and therefore cause interest rates to move up or down. Now, I don't presume that this is an exhaustive list. There are tons of things that might actually cause interest rates to fluctuate. But I do think the ones that are presented in the slides today are some of the major factors, all right? The first one that I want to discuss is wealth, investor wealth in particular. Now, just to remind me, how do we define wealth? What's the definition of one's wealth? It's the total value of one's assets minus that person's debts or liabilities, right? How is wealth different than income? What's the difference between income and wealth? These are principal questions. Santiago? So wealth is assets minus liabilities. Income is the flow of your earnings over a particular period of time, right? And depending on how much of that income or earnings you save, that can accumulate your wealth in the long run, right? Okay. All right. The basic point here is that an increase in investor wealth is very likely going to increase the quantity demanded for most financial assets. But it's probably not going to increase the demand for each different type of asset proportionally, okay? Let me give you a quick example. So when you guys graduate from college, you might be like me and only had maybe a few $100s in your checking or savings account. But once you go on and take your job, you start your career, your wealth is going to expand and your portfolio of assets is going to expand. Perhaps you don't put as much in checking and saving and you start to divert more of your wealth towards things like bank CDs or money market mutual funds. As your wealth grows even more, perhaps you will diversify into other types of maybe less liquid wealth, like stocks or bonds or even real estate, okay? The point here is that most of these assets are normal type of goods with respect to wealth, meaning that as your wealth increases, the size of those assets in your portfolio is also going to increase. That's the way we view wealth with bonds with respect to wealth. As investor wealth increases, the demand for bonds in the bond market is also going to increase. Let's work through an example here within the context of our supply and demand model. All right, so I'll just ask you guys this question. You can help me with the answer. Let's suppose that we are in the midst of an economic expansion. Okay, so the economy is growing, employment is rising, and as a result, the wealth of the investor class is expanding. How is that likely going to affect let's just say this generic bond market here? So here is our initial equilibrium point where the price of bonds is $960 and the quantity is 500. If wealth increases and bonds are normal with respect to wealth, that should do what to the demand for bonds here? It should increase it or shift it to the right, okay? And so as the demand schedule for bonds shifts to the right, then what do we know is going to happen? That's going to put upward pressure on the price of bonds in equilibrium. And so what is going to happen to the interest rate or the yield to maturity in that case? It should go down, okay? So the point of this exercise is the following. What this particular simple supply and demand model for bonds is predicting is that if the economy is expanding, economic activity is picking up, and wealth is accumulating, we should see higher bond prices and lower interest rates. All right? Let's ask the reverse question. What if we're in a recession? So now economic activity is declining, jobs are being lost, unemployment rates rising, and wealth of investors is also declining. Then the demand for bonds in this case is likely going to shift to the left, right? That puts downward pressure on equilibrium bond prices, and therefore what happens to interest rates or yields to maturity? They are going to go up. So again, what does this simple demand and supply model of the bond market predict about the relationship between interest rates and business cycle? During expansions, interest rates should fall. During recessions, interest rates should rise. Now, maybe that is a little confusing already, because if you look at the data, in most recessions, interest rates actually fall. In other words, we're probably missing something from this model in order to explain why interest rates typically go down in recessions. If I have time today, we'll try to answer that question more directly, okay? But all else constant, increasing wealth during economic expansions should lower interest rates, raise bond prices. Lowering wealth during economic recessions should result in higher interest rates. I know I'm going through this pretty quickly, so please stop me if any of this is confusing. Okay, a second major factor in how bond prices and interest rates are determined is based on the rate of return that a bond is going to earn over the holding period that the investor has. More specifically, it's really the expected rate of return, but I'll get back to that in just a second. Let's first define what we mean by the rate of return on a bond, because this is different than the yield to maturity. This is different than the coupon rate, okay? It has a different meaning. The holding period rate of return on a bond, or any asset for that matter, is the total return as a percentage of its initial purchase price. All right, let me call the rate of return on a bond capital R here, okay? Let's do an example. Let's suppose that we have a bond with a $1,000 face value, and again, a coupon rate of 8%. So it pays a coupon of 80 bucks per year, okay? If at the end of the year, the bond has appreciated in price to $1,271.81, then what was the 1-year holding period rate of return on this bond? How do we find that? It's the total return or income you get from holding that bond and then selling it at the higher price as a percentage of its initial purchase price. So in this case, your income from it is coming from two sources. If you hold the bond for 1 year, you're going to get one coupon payment of 80 bucks, right? However, if you now sell the bond a year later at this higher price, you're going to have experienced a net capital gain, like we talked about earlier. In this case, what is the capital gain? It's 1,271 and change minus the initial purchase price of $1,000. So the net capital gain here is 271.81. We divide that sum by the initial purchase price of the bond, and we see that it's equal to 0.352 or 35.2%. So the 1-year holding period rate of return on this bond, given its sale price, is 35.2%. What if instead the bad situation happens, right? And the end of year price on this bond is $812.61. What is the holding period rate of return in this case? Again, it has two sources, right? It's the $80 coupon payment, right? But now we've experienced a capital loss, not a capital gain. You bought the bond for $1,000, but you sold it for $812.61. And so your capital loss was $187.39. We divide that by 1,000 and we get negative 10.7%, right? So in this case, where the bond price fell by a substantial amount, the 1-year holding period rate of return was close to negative 11%. Okay, now, of course, anytime an investor is thinking about purchasing a bond, he or she does not know with certainty, right, what the actual holding period rate of return is going to be. Why not? Even though that investor knows what the coupon rate is, she doesn't know what the final sale price is, okay? That's not known with certainty. Now, so what that means then is that an investor has to base his decision on whether or not to buy a bond, not on the actual rate of return, but rather on the expected rate of return. I probably should have this definition below. The expected return is the return or your total earnings expected on a bond during some future period. Our example is just a 1-year holding period. All right. Now, we can make an informed guess or estimate of what the expected return is going to be by borrowing a concept from probability theory called expected value. How many of you guys and gals have had some basic stats courses before? Anybody? What is expected value? You guys know how to compute that? So let me give you here's my simple description here. What if I had a coin, and if I toss that coin and Jameson, it lands on heads, you get a point. If it lands on tails, you get 0 points. What is the expected value of one coin toss in that case? It's going to be half, right? How do we calculate that? You take the two outcomes, 1 and 0, and then you find the average where you weight them by the probability of each possible event. Heads is probability 1/2, tails is probability 1/2. That's the way we calculate expected returns in a financial context as well, all right? But to be able to do this, what do we have to know? We have to know what all of the possible returns are going to be, as well as the likelihood of each one. Now, in a real situation, we don't know what that's going to be, all right? But we can illustrate the concept if we just assume here that, just for the case of simplicity, that both of these end-of-year prices, in my example, are equally likely. So the bond is going to appreciate with probability 1/2. It's going to depreciate with probability 1/2. Can we figure out what the expected rate of return is? Yeah, it's just going to be equal to 1/2 times the high rate of return, 35.2, plus 1/2 times the low rate of return, that is negative 10.7. And so the expected rate of return is 12.25%. Now, be careful about how you interpret this, okay? This does not mean, Jameson, that if you invest in this bond for 1 year, that you're ever going to earn 12.25%. You won't. You will either earn 35.2 or negative 10.7. But if you were to reinvest in this over, let's say, many, many different trials, what you would find is that the average return over all of those trials would be around 12.25%. That's, I think, the right interpretation of how you should view expected returns. It's kind of the average over all the different possibilities weighted by the probability or the likelihood of each one. Okay, the point of this is that when investors think that the expected return on bonds is going to rise relative to the expected returns on other assets like stocks or real estate, that should increase the demand for bonds, okay? So let me throw this example. Here's a question I'll ask you. I don't have this in the slides exactly, but what if investors suddenly thought that expected returns in the stock market were going to go higher, but expected returns in the bond market are expected to be stable, not changed? What do you think happens to the equilibrium price of bonds and interest rates? That's what we're interested in here. Lauren? Yes, so remember, here's the key point here. I have relative, right? So if, in this case, even though the returns on bonds aren't expected to change, they are relative to the return on stocks. And so people would substitute away from bonds into, investors would want to substitute away from bonds into stocks. The demand for bonds would shift to the left. That tends to lower bond prices and raise interest rates, okay? All right, you guys have any questions then on that? So we've covered two things so far. Wealth is a key determinant of interest rates in the bond market, as well as expected return. Here's another important one. Jameson, go ahead. People that were holding bonds. Yes, yeah. So well, if interest rates were falling, then bond prices are rising. So to take advantage of that, they would need to then sell those bonds as bond prices were rising, right? And they bought them well before the crisis when bond prices were relatively lower. Yeah. Another key factor in determining market interest rates is risk, okay? What is risk? So this is basically defined as the degree of uncertainty over the future returns on any financial asset. You can think of it as kind of the degree of dispersion or the volatility around, of the returns around which a financial asset is going to earn, okay? Now, all else equal, most investors would prefer assets that are less risky compared to ones that are more risky. That is all else equal, okay? Now, risk for the purpose of trying to price a bond can fortunately be quantified by borrowing another of these concepts from probability theory called standard deviation. Now, again, I expect you necessarily to memorize these definitions. Maybe some of you remember this, but standard deviation is the square root of the average of the squared deviations of all the possible outcomes from their expected value, where that average is weighted by the likelihood of each of the possible values, okay? And then you take the square root of that whole term. Let's just apply this idea to compute the standard deviation of the expected returns on the example that we just worked through, okay? That way we can think about how much risk is inherent in that particular investment, okay? If we continue on this example where the end of year bond prices are equally likely in each case, then we can actually compute not just the expected return on this bond, which was 12.25%, we can compute its risk as measured by standard deviation. It would be the square root of what? The squared difference between the high return and its expected value, and the low return and its expected value, where you weight this average by the likelihood of each of the two events, so 0.5 and 0.5, okay? Now, the reason why we chose these numbers is because it turns out that the deviation here is the same from the expected value for both the high and low return, so that when you calculate the standard deviation, you get exactly 22.95 percentage points. Okay. So when investors are considering which different securities or stocks or bonds to purchase, one of the key things that is important to them is how much risk is involved over that return, okay? The higher the risk, that is, the higher the standard deviation, which is this measure of dispersion of the returns from the average returns, the less attractive that investment is going to be. Why? Because most investors are indeed risk averse. Do you guys remember what risk aversion means? You may have studied this in your intermediate micro or perhaps even your intermediate macro class. A risk averse individual is one that would prefer an asset with the lowest risk, given that it has the same expected return on all other assets, right? So Jameson, if you've got two investment options that have the exact same expected return, let's say 5%, but investment A has a standard deviation of 10% and investment B has a standard deviation of 20%, that means you're going to strictly prefer investment A because it has the same expected returns, but a much lower risk profile, okay? Now, I do want to point out here that again, because the vast majority of investors are risk averse, all else equal, they're going to prefer investments that have a lower risk or lower standard deviation. This does not mean that investors will refuse to purchase risky assets, right? They will, but those investors have to be compensated for taking on that additional risk. What form does that compensation take? A higher expected return. This is the classic risk-return trade-off, right? You can get investors to purchase more risky assets, but the only way you can entice them to do so is if you offer higher expected returns. So there is this trade-off in financial markets between risk and expected returns. For the purposes of analyzing the bond market, I guess the punchline here is that a decrease in the riskiness of bonds relative to the riskiness of other assets is going to increase investors' willingness to purchase bonds. So as the bond market is deemed less risky, that should shift the demand for bonds to the right, therefore increase bond prices and lower bond yields or yields to maturity. All right, let me give you just a quick little example of this. Back in late 2000, early 2001, the US economy went through this so-called dot-com bubble or dot-com recession. It was a pretty brief recession, all things considered. During that period, however, investors suddenly deemed most stocks to be much more risky than they had previously, okay? And so that means that bonds were, relative to stocks, deemed less risky. This pushed up the demand for bonds and therefore increased bond prices and lowered interest rates, okay? So the risk doesn't necessarily have to affect the bond directly. It's really more about its risk relative to these other potential assets that one can substitute for in one's portfolio. Okay, a fourth major factor that determines bond demand and therefore can affect interest rates is, of course, liquidity. All right, we have wealth, that's a key one. Expected return is extremely important. Risk is important in determining interest rates, but the degree of liquidity in an asset or in a bond in particular is also going to affect its interest rate, okay? And do you guys remember what liquidity means? Lauren? That's how easy or how quickly you can convert an asset into cash, right? Or how easily you can avoid large transactions costs when trying to sell off a particular asset, okay? It's basically a fact that liquid assets are more desirable for investors. Why do you think liquidity is desirable? It's a good economic question. In what sense is liquidity a desirable feature of an asset? Santiago? What do people and why is it safe? Because what do all people care about ultimately? Your stock of bonds and your portfolio of bonds and stocks doesn't have intrinsic value. The things that you care about are how much you can consume. That is the goods and services that you're purchasing every month or whatever, right? Imagine for a moment that, Santiago, so you've got some income that you're earning. If you suddenly lost your job and your income fell to zero, it would be you would experience a lot of economic pain if your consumption of goods and services also fell dramatically to zero that quickly, right? Because your utility would fall, right? Utility depends mostly on consumption and leisure as well. Liquidity of an asset is desirable because what does it do? It allows you to draw down your savings quickly without experiencing these huge transactions costs. In other words, you can smooth your consumption over time when you encounter these shocks to your earnings or your income, right? Pretty much all investors find liquidity attractive for this very reason, right? That you can sell it quickly and be able to smooth your consumption spending over time, even though you may be subject to these kind of random earnings shocks. Okay, now again, this does not imply that investors are going to be unwilling to purchase illiquid assets, right? Investors purchase illiquid assets all the time. A house is an illiquid asset, right? There are other types of assets that are illiquid. But what does it imply? Investors would be willing to purchase those illiquid assets if they're compensated for taking on that less desirable feature of the asset in the form of what? A higher expected return, right? So just like there is a trade-off between expected returns and risk, there is also a trade-off between liquidity and expected return, right? Money has no nominal return, but we don't require any return on it because money is perfectly liquid and it facilitates our transactions, right? But assets that are less liquid, like certain stocks and bonds, we're going to require a higher expected return because of taking on that illiquidity. A house is a very illiquid asset, but it's a little different, right? Because a house actually renders services to you that are valuable, right? So you value a home for slightly different reasons. again, I guess the main point as it regards the bond market, however, is that if the liquidity of bonds increases relative to the liquidity of other assets, then you might imagine investors are going to increase their demand for bonds. That's going to push up bond prices in equilibrium and therefore lower interest rates, right? If liquidity in the bond market suddenly went south, then the demand for bonds is going to fall, prices are going to rise, prices are going to fall, and interest rates are going to rise. Okay. I think I've got. Let me stop here. I think unfortunately I don't believe I'm going to have enough time to get through the last few slides before you guys leave today. I want to try to keep the presentation as contained as possible. So I'm going to, on Monday, we'll spend like the first 10, 15 minutes of class finishing up this section, and then we will move directly into the final topic of this semester on the term structure of interest rates. That is, how bonds that have different maturities but otherwise similar characteristics might have very different interest rate levels, okay? That's what we'll start talking about on Monday. If for those of you who came in a couple of minutes late, if you want your exam back or you have a